Guys, welcome to Bhavna's Online Academy. So this is the first chapter of SFM, which is Financial Policy and Corporate Strategy. So before I move on to explain about this chapter and the concepts, I would first like to explain the importance of this chapter. As you all know, in SFM, in examination, whenever you give a paper, it is not just practical or not just theory oriented, it is an equal mix of both. So usually when you write an SFM paper, 20 marks of theory is what you will have to answer no matter what, even given the choices in every single attempt. So 20 marks of theory is sure shot that you have to attempt, and it can come from any of the 14 chapters. Okay. And talking specifically about chapter number 1, in chapter number 1, it is seen that in every alternative attempt, a 4-mark question is asked from this. And since this chapter is really small, it is only about for maybe 10 pages. So what happens is that even a single point or a single word or even a small para can make up a question. So it is very important that you understand the chapter word by word and also remember all the points, and do not skip any of the paras, and it is also pretty simple only. So without any further ado, let's get into the video. Okay. Now starting with the first topic, which is strategic financial decision making framework. So before I go into very deep of this chapter, let me just give you an overview of what this chapter is talking about so that you're able to get the flow of this chapter. Okay. So in this chapter, what they basically tell you is an overall, they give you a bird's eye view of what business is, how finance or money is very important in any business that you start. Why is it important that an investor is there and you help them to give an maximum return every time you make profits, and what are the kind of decisions you will have to take when you are starting up a business or running a business. Why is it important in today's era that you have to think about sustainable growth. So all these aspects this chapter is going to touch upon, and it's a very basic chapter only. Okay, so starting with the first topic here, what they tell you is that they tell you that capital investment is the springboard for wealth creation. So what they tell you here is that whenever you have to start a business, okay, suppose today Ambani thought that he would want to start Reliance Trends, it wouldn't just start by itself. You would need money and finance for it. When and only when you're going to put money into a business, the business will be able to run itself and go, and it will be able to give you back money. So capital investment is a springboard. So only if you put money, it will give you money back. It's a springboard for wealth creation. Okay, so here what they tell you is, if you want to start a business, okay, now like I told you, you have to put in money into the business. So the people who are going to put money into the business will be known as investors. Okay, so what will those investors think? Suppose if you are one investor and you are trying to put money into a business, then what will you want? You will want maximum return out of this business. You will want maximum return at minimum risk. That will be your expectation. Now, who will help you achieve this expectation of yours? The people who are running this business or who are managing this business. The management is going to be ultimately responsible for helping you fulfilling your expectation and satisfying the shareholders. Shareholders means people who have invested in the business. Okay, so they will help you, bring you to an optimum financial position. Okay, why? How are management going to help you help an investor do all of this? Is because management has the power to take the most important investment and financing decisions of an organization. It is in the management hands to decide where this money is going to go, whether you are going to start a new branch or whether you're going to have only one branch and construct 3 floors there because it is a main city point, or whether with this money you are also going to invest somewhere else and not only in your business. So all kinds of investment and financing decision lies in the hands of management. So management will be ultimately responsible in helping investors meeting their expectation. Okay, so this is how the basic starts. But here what happens is that the money is a limiting factor. Capital is a limiting factor. You don't have all the money in the world to put into your business. Okay, the money that you have is limited only. Correct. Ambani did not have all the money in the world to start Reliance Trends. Whatever money he had earned and he had saved, only that he could use to put into his business. So here what happens, what problem arises is that with that limited money that you have, you have to use this money or this finance in the best possible way. Okay, so you have to strategically allocate this limited funds that you have between alternative uses. Okay, so if you might have 100 things, you might have suppose 10 things to fulfill right at the moment for the business to start well. So in that 10 things, in how much of this thing, suppose you might have to do marketing also, suppose you might have to do cleaning of that place also. Okay, suppose these are the 2 tasks that you have to do in order to now kickstart the business. Okay, so now in marketing, how much will you allocate? In cleaning the place and the properties so that the good ambience could be created, how much would you invest? So like that, you have to strategically allocate. Okay, so only when you're going to strategically allocate your limited funds, you will be able to sustain or increase the investor returns which are there, because that will only help in business in giving maximum return. Okay, so you have to continuously search for good investment opportunities that will generate funds for your business and also will be favorable for the investors. Okay, so this is the basic. Okay, so now let's read what are the 3 fundamental essential elements of a business. Okay, so there are 3 elements which will help in making up the fundamentals of the business. Okay, now so today if you're starting a business, okay, now suppose if you're starting another sari shop today to be a competition to the Reliance Trends, or a clothing shop to be a competition to Reliance Trends. Now if you're planning to start a shop like that, then what are the 3 elements that you have to remember is that first is a strategy. You need to have a very clear and a very realistic strategy that how are you going to compete with a big brand like Trends. Okay, that strategy is very important. Second is that you need to have the financial resources. That means you cannot just start a clothing shop that can compete with a huge shop like Trends and just like 1 or 2 lakh rupees. You would need a huge financial resource, money. Okay, that, and how are you going to control where it is going to come from, how you're going to invest it, how you're going to finance it, all of those decisions also you'll have to take. So financial resources are also very important. And the third very important thing is a person who has a very clear vision, the right management team, and what and all process you will need to make it happen. So all of these things you should also have. Okay, so the first is you will need a good strategy, second is financial resources, and the third one is the right management team and good processes to help you achieve your goal. So all these 3 is what is that makes up the fundamentals of business. So it is strategy, finance, and the management. So this is how our subject name has come, strategic financial management. Okay, so this is the fundamentals of business. Yes, so here now let's see what is strategy. Okay, so strategy is nothing but what you want to do in the long term. Now if I have to beat Reliance Trends in the long term, what direction would I want my firm to go in, and how would I achieve my objectives? So suppose if you know, suppose if you're playing football, okay, and these are the 2 nets and there are 2 teams. Okay, so now we are of this team. Now if you have to put a goal towards the opposite side, because that's where our goal is, then in such case what you would need a strategy that how with the other team players you're going to play so that you're able to defend the opposite team and also achieve your goal. Okay, so that is what is basically strategy. So strategy is a long-term direction and scope what an organization wants to achieve. They would want a competitive advantage also. Okay, so to win over somebody, you would need a competitive advantage. You should be good in something. If suppose Trends is good at giving offers because they have a huge amount of cash flow anyway, our firm would not be able to do that. Our company would not be able to do that. We should maybe we can aim for competitive advantage through making quality products. Okay, so here what you would do to achieve this, you would configure your resources in such a way that even in this changing dynamic and competitive advantage, you are able to fulfill the stakeholders' aspirations and expectations. Okay, so this is what is a strategy. So let me, before moving on into the chapter, let me tell you these definitions are also very, very important. You have to remember them. So once I complete the chapter, kindly go through each of the definitions and try to remember it as well. Okay, yes. Now let me come on to the next part, which is the functions of strategic financial management. So in strategic financial management, what do you do? When you start a business, what do you do? Okay, So first, what do? Is you search for, so suppose now you have money in hand. So with that money, what are you going to do? You are going to search for the best investment opportunities. Okay, suppose now let's talk as an individual itself. Now, if I am an individual and I have 1 lakh rupees in hand, I will search, whether should I invest in mutual funds, equity or debt, or in what should I invest in, so that I'm able to find, get profits from it or get good revenue from it. So once you have searched, once you have searched for best investment opportunities, you need to select the best profitable opportunities. See, there might be 5 opportunities in front of you, but not all of them would be profitable. Okay, so you need to find which ones are profitable to you also. And after that, you have to determine how much funds you're going to put into which of the opportunities. What is the most optimal mix of funds that you can invest through, okay, in these opportunities. Okay, so now once that is, and you have, you did a search, you found out profitable opportunities, you did an optimal mix and invested in those. Now, after these, what you will do is you need to establish a system of internal control. It is not only important that I just, invest in something and keep. I also should need to ensure that whether the internal controls, in case I can have internal control as an individual, that every month I will regularly check if my equity in what I have invested in, the stocks that I have invested in, is going up or down. In case if it is going down, then I will sell it off. So internal control I have made. Like that, a business will also make a few internal controls to make sure that the finance that they have used is going into proper use. Okay, that means in finance that they have invested is going into proper use. Okay, so establishment of internal controls, and finally you will analyze what are the results, okay, that have come out of whatever you have invested, and that you're going to take help for making decisions in the future. Okay, in the next time whenever you're investing, you will keep all of these analysis into your mind, that from your past experiences what you have gained and how you're going to use it in your future decision making. Okay, yes. So moving on to the next part. This is one of the most important questions, something you have already learned in your intermediate itself, but this has been asked in your January 21 attempt for 4 marks, in your November 19 attempt for 4 marks, and even in your RTP of November 20. Okay, very simple question, but it has a good amount of weightage in the exam. This question is seemed to be also repeated in examination. Okay, so here they tell you what are the key decisions falling within the scope of financial strategy. Now we are talking about how we have to use the finance, how we are going to strategize it. Okay, so whenever you are making a financial strategy, what are the key decisions that you will have to take? So there are 4 key decisions. First is financing, second is investment decision, third is dividend decision, and the fourth one is portfolio decisions. And the fourth one is portfolio decisions. Okay. So here, with the help of pictures, I'll simply explain you. First, you will have to take a financing decision. Whether, whenever you are going to, finance for your own company. Now, if I've started my own company, I would want money into my company. Whether should I get it in the form of equity or in the form of debt, I have to make a decision on that, or what will be the optimal mix of both that will be helpful for my organization to grow in the future. Okay, so that financing decision you will have to take. Second is investment decision. So in investment decision, the decision that you're going to take is that now you will have to invest your money. Now in the first decision, you have got the money. Now that money that you have got, you have to invest it somewhere, correct? Now when you are going to invest it somewhere, you have to think which will be the most profitable for your organization. Okay, so here these decisions involve profitable utilization of firm's fund, especially in long-term project. Now if suppose I have a decision, now I have made a decision of getting the money for a clothing brand that I'm going to start. Now I have to think whether should I invest in opening 4 or 5 branches in different areas, or whether should I invest the entire money in one single building and make it the best building and best looking building and the most largest building or the most largest shopping center of the town. So these investment decisions I have to take, which is going to be a long-term decision, but you must try to make it the most profitable. Okay, so you have to think of all the risks and the returns you're going to get, and you have to pick a safe decision out of it. The next is dividend decision. In dividend decision, now that you have invested, you will start getting returns from it. That returns that you're going to get, whether you're going to retain in the business for further development and the further growth and expansion of business, or whether some part of it would you want to even give it back to the people who have invested in you. That decision you have to take. So dividend decision. And the final decision is portfolio decision. So in portfolio decision, what basically happens is that you would have invested in 2 to 3 projects. Okay. You have to now see whether in the project that you invested, okay, suppose now recently you invested in one particular project, you have to see that this project, how much returns is it giving to you in comparison to all the other projects. So here portfolio decision means, yes. So here portfolio decision means evaluation of investments based on their contribution to aggregate performance of the entire corporation. So you have to look in aggregate that this particular project, suppose project number A, how is it performing? Okay, so that is portfolio decision. So these are the 4 decisions that you will have to take within the scope of financial strategy. Okay. So I hope until this you would have understood, and this is one more way of asking the same question. So this was a question paper question, if I'm not wrong. They had asked in exam that as a financial strategist, you will depend on certain key financial decisions. So discuss them. So in that case, you would have to answer these 4 points. Okay. So now moving on to the next topic. So now we are going to understand that strategy. Whenever you make a strategy, you can make a strategy at different hierarchy levels. That corporate level, that a top management can also take a decision, a general manager can also take a decision, and an employee working may also have his own decisions to make. So different levels of an organization, different decisions can be taken, correct? So now we are going to understand how different levels of an organization are going to make strategies and what kind of strategies are they going to make. So as you all know, there are 3 levels in a business. One is a corporate level, then you have the business level, and then you have functional level. Correct. So there are these 3 levels in an organization. So talking about corporate strategy. So in corporate strategy, as you all know, the decisions are taken by the top management people. So what will a top management, what will a person like Ambani think? Okay, like the person who is owning, who is in the management of the organization. Okay, so he will think which business he should be in, what next business if he is in will help him to grow more, will help him to make more profits, will help Reliance go to another level. Okay, so that is a corporate, that is a strategy that the top level management will make, which is known as a corporate strategy. Okay, so if you see here, corporate level strategy, selection of business in which a company should compete. Okay, so whenever you are taking a corporate level strategy, you are making a corporate level strategy, you should be able to answer these 3 basic questions. Okay, this will be known as your SFA. Okay, first is suitability. Okay, now suppose if we are starting Reliance Trends, okay, so what will Ambani think? Whether this business is suitable for the objectives of our company, whether right now if your objective is to make more profits, if Reliance objective is to make more profits, whether if I open a clothing shop, will it help me to gain more profits? Because right now, clothing is a very huge trend. People want to wear different kinds of clothes every single day of their life. So now what happens? Such a business is going to definitely prove profitable if you're going to give it at a reasonable price with quality goods. So this is a suitable business, correct? Next is feasibility. So feasibility, you see whether you have the number of resources that would be required and the kind of resources that you would be required to implement this strategy. Now, if you, suppose want this Reliance Trends to be opened in the center of the city, then you will have to pay a huge amount of rent. Okay. And also the people who are going to be hired in your organization, the employees who are there, they will also expect a good amount of salary. It would not be the salary that you can pay in a town or a village. Correct. So you should see whether you have the kind and number of resources that will be helpful in implementing the strategy. Finally, it is acceptability, whether stakeholders are satisfied from this decision or not. Okay, so these are the 3 things you must be able to be answered. And if these 3 outcomes of these 3 questions are positive, then that corporate level strategy is a good strategy which you have taken. Okay. The next strategy that you're going to talk about is the business level strategy. Now suppose if Ambani has taken a call that he would want to go into clothing line. Now that is a call he has taken. Now who is going to manage the clothing line? Suppose say Trends is the business level people, because here there is Reliance, and below Reliance there will be Jio, there will be Trends, then there will be Petroleum, there will be different things. Okay, so Reliance, as this top management cannot handle all of each of its own segments. So for each of a segment, there will be a business level sitting there. Okay, so these business level people specifically, now let's talk about Trends. Now, what are they going to help is they are going to think of tactics to beat the competition. Now, there is a store called Zudio, which is run by Tata. They are providing good quality or maybe an average quality of clothes at very, very reasonable price. Now, in case if they are a competition to them, how are they going to beat this competition? How is going to Trends come into picture and going to take the overall number one position in market? So that is a strategy that the business level people are going to take in. Okay, and finally comes the functional level. So that under Trends also, there will be different functions which are there. There will be R&D, there will be procurement, then there will be marketing. So each of these decisions is also run separately. So each each department owner, okay, or each department head, or let's call it the functional level people, they will also take a few decisions which will help in the growth of Reliance and Trends. Okay, so they will take decisions in relation to the operational methods. Okay, now suppose if we have, let's talk about marketing in specific. Okay, now suppose Reliance has thought they are going to beat Zudio by doing so and so things. Now it is dependent on that functional level people or the functional level department. Now suppose marketing department, now they have to bring all of these strategies into force by bringing up good offers. Now suppose in business level they thought that we'll give good offers against Zudio. Now what kind of offers are you going to give? Are you going to give buy one get one free, or are you going to suppose give buy this and take 30% off, buy 4 pieces and get one free? So what kind of strategies are you going to make at the functional level also matters. So these are the 3 levels of business, and how these 3 levels of business comes up with strategy which is going to help them achieve their future objective or their goal in the future. Okay, so here I told strategy, business level strategy. What do? They help in the coordination of operating units, and they will help in sustaining a competitive advantage with whatever products and service you are producing. The functional level people will do the functional level work, and in that, using that operating work, they'll help you achieve the objective. Okay, so you can just give a read through this. Okay, fine. So now that is also over. Now we come to one of a little complex topic which is there in the chapter, which is a little apart from what we have been talking until now, is financial planning. So what is financial planning? In the first line of financial planning, they have told that financial planning is a backbone of business planning and corporate planning. So whenever you make a big business plan that is going to earn you hundreds and crores of revenue and profits, or a great corporate strategy which is going to help you hold that number one position in the market, behind all of this, financial planning is one of the most important things. Okay, yes, it is a backbone. Now, why is it a backbone, or how are we going to use it, is what we are going to study now. Okay, so first, what is financial planning? Financial planning is a systematic approach whereby the financial planner helps the customer to maximize his existing financial resources by utilizing financial tools to achieve financial goals. Okay, so let me split up this and explain. Okay, so now suppose now I am one customer. Okay, now suppose this is Ambani. Okay, he is the customer. He will go to one person who is a financial planner. This person is a financial planner. His name is suppose Raju. Okay, this person. So for the financial planner, Raju, who is the customer right now, he's dealing with Ambani right now. So he'll help his customer to maximize his existing financial resource. Suppose now Ambani has 10 crore in hand. Okay, so this financial planner is going to help him maximize this. From 10 crore, how can you make it 100 crores? He's going to help you do this by giving you good strategies and good plans. How is this going to be, so how is this going to be practically possible? You have to use a few financial tools Okay, maybe you will make an industry analysis, maybe you will make a few ratio analysis, maybe you will use a few other financial tools which you're going to read below, and using those you will help Ambani to achieve his financial goal of 100 crores. So here what you do, financial planning is a systematic approach whereby this financial planner is going to help his customer maximize his financial resources using a few financial tools and help him achieve his financial goals. This is what is financial planning. Okay. Now there are three major components in financial planning. Okay, one is your financial resources. You would need financial resources. That is the 10 crore rupees that you have in your hand. Then you would require financial tools, so that using these tools, you help these resources convert into your goals. Now these tools can be namely, it can be a ratio, it can be industry analysis that you have made, industry analysis that you know, right now with this 10 crore rupees, if you go and invade the mobile business, or if you go and invade into the clothing business, this will help you in going from 10 crores to 100 crores. Now this industry analysis is one of the financial tools the financial planner is using to give you insights so that you're able to achieve your financial goals. So financial resources plus financial tools plus financial goals is what is known as your financial planning. Okay. So now until now we have studied about what is financial planning and what were the three elements that make up financial planning, right? So once you have done your financial planning, what are the outcomes that you're going to get from it is what we are going to understand now. And this is one of the questions which was asked in May 22 for 4 marks. Okay. So outcomes of financial planning. So there are three outcomes which can come out of a financial planning. The first thing is, whenever you do a financial planning, you are very clear about what your goal or what your future goal is going to be. If your future goal is going to be to earn a revenue of 100 crores, you're very clear with that. So whatever rest of the decisions you are going to take, it is going to be very easy because the goal is very clear in your mind. Tomorrow, if anybody comes up with a new business plan, you will say no, because you have already pre-decided what you have to do with the 10 crores that you have in hand, so that you can make it up as 100 crores. Okay, only and only if it is helping you achieve your financial objective which you have set earlier, or the financial goal which you have set earlier, you will take up that particular decision. Okay, or else you will reject the proposal that you have got. So the financial objectives, you get very clear about it, and the rest of the decision also falls into place. So that is the first outcome. The second outcome is that about financial decision making. So what happens whenever there is any financial problem, you analyze the financial problem and take the best course of action, because you have already financially planned what you have to do. If there is no plan, if there is any problem that is going to arise, okay, you will only think of short term and get a solution in place according to whatever is beneficial to you in short term. Correct. In case if you have planned for the long term and you know what you need in the long term, then the financial problems which are coming up now, you will analyze it and select the best course of action, so that it is helping you to achieve your financial goal which is there in the long term. And the final outcome is the financial measures. Okay, so the ratio analysis that you do after every financial year end, or the cash flow statements that you prepare, you will analyze them all, and you will see, you will evaluate the performance of the company, whether according to what you had planned, the outcomes are coming up or not. Okay, so these are the three things. One is financial objective, financial decision making, and financial measures. Okay, yes. So now that we have understood about financial planning, the next topic we move on to is the interface of financial policy and strategic management. So here what they tell you is that when you are running a company, there are a lot of policies that you will have to be made, and that includes your financial policy also. That means policies related to how you are going to utilize your money, where you are going to source it from, where you are going to invest it in. So all of these policies requires a few strategies to be in place, and depending upon those strategies, you make the financial policies. Okay. So now here we are going to read what is the connection or the interlink between financial policies and strategic management. Okay. Yes. So now let's understand. Okay, so here they tell you that the starting point of an organization is also money and the end point of an organization is also money, because you invest something in the business which is money, and the end outcome that you're going to get as revenue or profits is also money only. Correct? Yes. So now we are going to see 4 areas which clearly indicates the relationship between financial policy and strategic management. Okay. So the first one is sources of finance. So in sources of finance, you understand whether you decide whether the money that is going to come into the business, should it be the money of the owners themselves, or it should be the ownership capital, or can it be borrowed capital also, or can it be a good mix of both? That you will take a decision here. Now that how or what you're going to raise money, in which way, all of those will be your financial policies. But how is strategic management interlinked here is that here what you do is you see whether you want to dilute your ownership now, or you want to keep all the ownership to yourself. In case if you want to source more fund in the future, then according to that you will dilute your ownership. So these strategies you make up now, and related to that or according to that you make up the financial policy. Okay, so a company may issue equity shares or preference shares for mobilizing ownership capital. So in case if you want to keep it as owners related capital only, you'll try to issue equity shares and preference shares. And in case if you want borrowed capital, then you will issue debentures. Okay, so depending on what kind of mix you want, the sources of finance is decided. Okay, so this was the first point. The second point is about the capital structure. So here in the first, it was mainly about how you are going to raise the money. How are you going to raise the money? In the second point, when they talk about capital structure, here you are going to talk about what will the mix of equity and debt capital is going to be, in what ratio are you going to keep. If it is a public sector organization, then they tell 1:1 ratio is a good. If it is a private sector firm, then they usually, as per industry, 2:1 ratio is good. Okay, so depending on all of these, you will decide what kind of mix you would want. Okay, so here, yes. So here they tell you that if it is a capital intensive industry, then according to that there will be one mix, and if it is a high cost project, then according to that it will be a mix. So depending on your strategy, whether in the future you're going to take up high cost project or low cost project, you can decide your capital structure now with it. So this is how your strategy management is going to help in your financial policy. Okay, and then the next one is investment and fund allocation decisions. Yes. So here, whenever you're going to have money, you are going to invest it somewhere and you're going to allocate it somewhere. Okay. So when you're doing that, before making the investment or before allocating your fund, you have to do project evaluation and project selection. Now, project evaluation and project selection are a part of strategic management. You see, if you have 5 projects in hand, which of the 5 projects would prove the most profitable, or which would prove or help you to gain the #1 position in the market? Which of these 5 projects will help you in making the most of the money? So in that term, you're going to take up a decision. For taking up that decision, you will evaluate all of those projects and select one project. So here you're doing strategic management, and according to that, you are going to invest your money in that. So that is financial policy. Okay, and the final one is dividend policy. So dividend is also just letting go of money from the company's hands and giving it to the giving it to the people who have invested money in the business. Okay, so that is a financial policy, but here also strategy gets involved. How? So here there are 3 ways by which you can have your dividend policy. Either you can have a stability dividend policy, whereby you say that every year we will pay so and so amount of dividend. Okay. And then the second policy might be such that you have a constant percentage of net earnings, that every year, in case if you're going to earn this much, every year 2% of our net earnings we will pay as dividend. Okay, so that can be one more policy. And the third policy might be a mix of these both, that you pay a minimum dividend per share every year, and along with that you pay an additional dividend depending on how your earnings are. If your earnings are more than normal earnings, you pay more dividend. If they are less, you pay less dividend. So it is a mix of both. So here also strategy gets involved, because here what happens, if you are having a stable dividend every year, it is very sure that it is going to have a positive impact on your share prices. So if you want a positive impact on your share prices, if that is more important to your company, then in such case you will choose a stability strategy of dividend payment. Okay. So here strategy and finance both plays a major role. So if in an exam they are going to ask you, so this was a question in May 18 which came for 4 marks, that you have to explain the financial policy and strategic management. Okay. So here you will explain it in the aspect of these 4 points. One is sources of finance, capital structure, investment decision, and dividend decisions. Okay. Yes. So you can once read through it. I've just given you an overview. The content is more here. So once if you give an overview, I mean read through it, you will be able to understand what you can write in the exam. The main important keywords I've explained you here. Okay. Yes. Now moving on. The next question is, how are you going to balance your financial goals by keeping in mind your sustainable growth too? So this the question on this was there in RTP May 20 and MTP May 22. This has not been yet asked in the exam. So there is a very high possibility that in the upcoming attempts, this question might come through. Okay. Yes. So now talking first about what is sustainable growth. What is sustainable growth? Okay. So here what happens, let's take the example of a let's take the example that is given here, which is oil industry. Okay, so what you basically do is you extract oil from earth and then you sell it. You're going to extract oil from earth and then you're going to sell it off. Okay, so this is what you basically do. So now what happens here is that now in case if you would have seen the movie of KGF 2, in that what the hero decides is that what he is going to do in the upcoming 2 years, whatever gold is there in that gold mine, he is going to extract it all and make the most of the money. But what is going to happen after 2 years, if all the gold has been extracted from the mine completely, then after 2 years, they have no clue how the company is going to be run, correct? Okay, so here what happens, we'll take a similar example of oil industry so that you're all able to understand better. So here what happens is that there is a oil extracting company which extracts oil and sells. So here first there is two kind of company. One is a good company and then there is a selfish company. So what this selfish company does is they have a goal that whatever oil is there available now in the natural earth, they are going to extract it all and make money as soon as possible in the future. So what they do is that they are going to extract, make money, extract, make money, extract, make money, and then they are going to reach a point where the natural resource of oil has completely got depleted and it's not there at all. So what will happen after, suppose they have done this in a span of 2 years. So after 2 years, their profits are going to directly drop because they're not going to get anything from the earth which they can sell and make money out of. Whereas now if this good company is there, what this good company thought is that they've thought of long term. That in the long term, I would want to make reasonable amount of profits, but I would want it for long term. Okay. So here what they do is they extract oil, then they leave it for 6 months to be restored. And at that time, they don't make any profits or revenue. They again extract and leave the earth to restore itself. Okay. So like this they do. But at the end, they end up making more profits. And this is more sustainable also because it will help the company to survive in the long term also. Okay. Because whenever you make a company only with the goal that it should survive in the long term. Correct. Yes. And also make profits. This is also making profits. A good company is also making profits, but at a low pace. Okay. Yes. So this is how your company should plan. Okay, this is how you should plan your financial goals of making profits, but you should also keep in mind the sustainable growth. Okay. So here, yes. So here they tell you that what happens is that a conflict can arise if growth objectives are not consistent with the value of the organization's sustainable growth. So whenever you are thinking of sustainable growth, the growth objectives that you have made for your own company should also be in line with the sustainable growth. Or else what might happen is the decision making might not be so easy. So whenever you are going to take decisions about how you want to distribute the resources that you have in your firm, it will be very difficult Because here what you're thinking of not the current people who are there in the company and not for the current stakeholders how you want to make profit. You are also thinking of how for the future stakeholders you want to make profit, correct? So here whenever you're going to take decision about how to rightly distribute the resources, it is going to be a difficult decision. But if you make the right decision, it will be good in the long term. Okay. So here an example is that this is a live example of what is happening. So here the Indian Oil Company made an ad. Okay, committed to conservatism, committed to growth. Okay, so Indian Oil pledges its commitment to sustainable practices in addition to responsibly fueling in nation's growth. Okay. So right now, whenever a person is going to invest in a company, they're also going to look at how the company is thinking of sustainably growing in that, because you don't want to put in money today and be in losses day after tomorrow, right? Yes. Okay. So this is one of the live examples. This is just given there. Okay. Yes, and that's what was given here, whatever I've explained. So they're telling sustainable growth is important to enterprise long-term development. I've explained you this already. So in one of the RTPs or MTP, one time the question was given directly. The other time what they did was they took a line from this entire paragraph and asked it as a question. Often a conflict can arise if growth objectives are not consistent with the value of organization sustainable growth. Explain. So here you had to explain this entire paragraph. Okay. So I hope you understand the importance of even reading through the lines and inside the book for this chapter. Okay. Yes. Next, what we are going to see here is how can you make an organization financially sustainable? Okay. Yes. So here, if you have to make an organization financially sustainable in the long term, okay, you would want that the organization should have more than one source of income. Okay. Now, just imagine if you know Ambani is there. Okay. And he had a telecom sector also. Now, what happened today? 1 minute. Yes. Now Jio is the number one market player in the telecom sector. Correct. Now there was Aircel. Okay. Now how was Aircel defeated? Aircel was defeated because of Jio's invasion into the telecom industry. Correct. Now if Aircel had one more source of generating income, that the main company of Aircel. Okay, if it had one more source of income or one more way of generating income in that firm, then even when Aircel was running into losses, they could have backed the Aircel with another source of money if they had one more segment or another business which was profitable to them. Okay. So here it is very important that you have more than one source of income. That means in case if you are having a main business, you're getting income from that also. Then you have invested somewhere, you're getting income from that also. Okay, so like that you must have more than one source of income and you must be able to generate more than one way of income. What is the difference between this both? More than one sources of income means if Reliance is there, Reliance is generating income from all of its businesses and also from investment, from mutual funds, equity, debt. Okay, by investing in that, they are getting money from that. More than generating more than one source of income is that in the business itself, they are generating more than one form of income by having different segments. Okay, that Reliance they are generating, Trends they are generating income from, Jio they are generating income from, and the same way if they have invested outside also, in investment outside also they have different ways of getting income. One may be mutual funds, other may be equity, like that. Okay. So the sources should be there. In that sources also, you must have more than one way of generating income. Then you must strategically plan. Okay. And you must plan regularly. Whatever finances you are having in your hand, how are you going to allocate it? What action you are going to take towards it? What are the strategies you should have for it? You must do the planning for it regularly. Okay. And you should have adequate financial systems for it. Okay. You must always keep in check where your money is going, where your money is coming, who is approving the money to be gone outside, and who is approving the money to come inside. See, all of these you should have. And if a company has a very good public image, in the long term, it will help the company. See, now if suppose take Tata. In Tata's business, nano car was a big failure and it could have taken the business to just, roads and racks. So, but what happened, since that company had a very good image of other products too, it was able to sustain in the long term. Okay, then it should be very clear about its value, its value. If you now see if, Ratan Tata's Tata company, it is very clear about how it wants to help the society and how it wants to build a nation where even the society's upbringing is also upliftment is also involved. Okay, and not just about thinking about profits alone. And it should have financial autonomy. It should not be completely dependent on outside sources of finance. Okay, so this answer you can easily remember by, I'll give you an example. I'll give you one more example which is not relevant to business, but one way of remembering this answer. Okay. Now suppose if there is a girl, okay, if there is a girl and if she is going to see a groom for herself, okay, if she's going to go and see a groom for herself or a prospective person she could marry, what and all are the criteria that she is going to have in mind to select that person? First is that he should have that he should have more than one source of income, that in case if tomorrow he loses his job, then also he must be able to support the family. The second one is more than generating more than one way of income. These both points go hand in hand. Okay, so more than one source of income and more than one way of generating income. Then he should have a good financial planning. He should have saved up money for himself, for in the future, for the children's education, for its marriage expenses. All those financial planning should be there and very well performed. Okay, and then he should have adequate financial systems, that he must have a system that he must have a check about how his money is coming in, how he is spending, how much is he saving every month, how much is he investing every month. So adequate financial system should be made so that everything is in check. Okay, and he should also have a very good public image, so that when you're going to marry him, your public image also stands good. Then he must also be very clear about its value. Suppose if you have a value that he should not smoke or drink, he should also be very clear on that value, whether he will drink or whether he'll smoke or will he not. Okay, and he should have financial autonomy, that he should not have a lot of debt on his head and tomorrow you go with him and you suffer along with him. That should not happen. He should have financial autonomy. Okay, so this is how you can remember this answer. What makes an organization financially sustainable? Okay, so I hope until this it is understood. Any doubts until now? Okay, fine. So I think there are no doubts. I'll continue. Yes. So in case if there is any doubt, you can put it in the chat box. Okay. Yes. Next is sustainable growth rate. Okay. So sustainable growth rate. So how are you going to find out a growth rate which is going to help you sustain in the future? Okay. So sustainable growth rate means if there is a firm and if it is growing at suppose 50% every year, but according to your sustainable growth rate, your growth rate must only be 20% every year. This is your sustainable growth rate. If you have this growth rate, you will be able to sustain in the future or in the long term. But if you have this growth rate, your company will come to ashes very soon. Okay. So now you have to find out what is your sustainable growth rate and try that your company goes in line with that. Okay. Yes. So now let's read on that. So here what they are telling, until now we read sustainability in terms of society. Now sustainability, when it comes about an organization, they tell you that an organization sustainability means how much a firm can grow without borrowing more money. Without borrowing more money, how much your firm can grow, that much your firm will be sustainable in the long term. Yes. So here they are telling you sustainable growth rate is the maximum rate, okay, of how much your growth in sales can be achieved. Your maximum growth in sales can be achieved 20% only, keeping in mind your profitability, asset utilization, desired dividend payout and debt. Keeping all of these in mind, you arrive at a ratio which is known as a sustainable growth ratio, which will help you be effective and be alive and keep your firm be in a going concern in the long term. Okay, so this sustainable growth rate is a growth rate of growth in sales. 20% you can grow in sales every year, keeping in mind all of the other factors also. Okay, yeah, so in simple terms, it is how much a firm can grow without borrowing more money. So what is the formula of finding sustainable growth rate? Sustainable growth rate is return on equity multiplied by 1 minus dividend payout ratio. Okay, so how much you want to 1 minus dividend payment ratio is nothing but also called as your retention ratio. How much you want to retain in the business and how much you are going to provide return on equity. So multiplying that both, you will get your sustainable growth rate here. Okay. So there are a few assumptions of this sustainable growth rate. Here they tell you that I wouldn't explain much on this because this is just an assumption which is made to bring up the formula which is given here. The first assumption is that the capital structure, you will maintain the same capital structure without issuing new equity. Okay, you will not issue new equity and you will maintain the same capital structure. There will be, and you will also maintain a dividend payout ratio and there will be no changes in that. And as your increase in sales will be rapidly as market conditions allow. So as much as your market condition is allowing, you will increase your sales accordingly. So there's no change in capital structure, no change in your dividend payout ratio. And then your change increase will be according to how much your market condition is allowing and not how much you want selfishly. Okay. So these are the three assumptions which are given here, based on which this formula is made. Sustainable growth rate equal to return on equity multiplied by 1 minus dividend payment ratio or multiplied by retention ratio. Okay, so that was about your sustainable growth rate. And then there is one more question which asks what makes an organization sustainable. Before this also we had read one question which was what makes an organization financially sustainable, not just in general, in related to finances and money. How can an organization become sustainable? We read that before. Now we are going to understand what makes an organization sustainable. Okay, just in general terms, how can an organization be sustainable? First is it should have a clear strategic direction that where it want to go into in the future. Okay, so if it has big goals, then it should be able to scan its environment and should be able to identify the opportunities where it can work and make good revenue or profit out of it. Okay, and to do all of these in the company, there should be very good competent staff. Okay, intelligent people and good entrepreneurs should be there in the company so that they are able to bring out the vision and are able to and are able to attain it. So your company must be able to attract, manage and retain these competent staff in the company itself. Then it also must have the adequate administrative and financial infrastructure. In case if you need 10 crores right now to make 100 crores in the future, you must have that financial infrastructure or at least a way by which you can get that 10 crores. The same way the administrative infrastructure should also be there. Okay. And then it should be able to demonstrate its effectiveness and impact in order to leverage financial resources, in order to leverage further resources. So in case if you need more resources in the future, okay, suppose you want more money, let's not take money. Like in case if you need more competent staff in the future, your company must be able to demonstrate to the prospective employees that it is effective and it is creating an impact in the society and it is going to make big in the future. So you will also, the employee who is going to come in the organization and work for the organization will also be able to grow very well in the future because the firm is also going to grow in the future. Correct. And then you must have the community support. The society must support you in order you should grow. Okay. And involvement in its work. So this is how you can make your organization sustainable. Okay. So here, okay. So here, the same thing. How you can remember this easily? I'll give you an example so that you're able to remember it and write it in the exam. Okay. So the first thing is here. What we are going to see is if a girl is there, and in the first example, she was looking for a prospective groom or a prospective marriage partner. Now what has happened is the girl has been married off with his partner, now is going to come into the in-laws home. Okay. So to be sustainable there, what and all she has to think. Okay. She has to have a very clear strategic direction that how much years is she going to stay with the in-laws and after how much years is she going to move apart from the in-laws and stay away in a different home. That clear vision first she should have. Okay. So then second, what she should have, so because she is newly married and have just come into a new home, she must be able to scan the environment in the home, and if there is any opportunity where she can get good name, she must be able to identify those opportunities and make it work for herself. Okay. And then in case if there are more people in the family, suppose she is living in the joint family, then there are going to be a lot of people in the family. Okay, she must be able to attract them. She must be able to manage them and retain them to her side. Okay, so that they always support her. Okay, and then they must in that new home wherever she is going, that they must have adequate infrastructure there. Okay, administrative and financial both. Finance also they must have, and administration wise also they should have good infrastructure. And then she must be able to demonstrate that she is effective in work and she can create an impact in the house, so that in case if in the future, in case if she needs anything, the family always supports her, okay, in her decision. So she gets a community support because she is involved in all the work in the house. Okay, so this is how you can make it sustainable. So here she must have a very good direction what she want to do in the future. She was be able to scan the environment and get opportunities where she can get good name for herself. She must be able to attract the people who are there in the family, so that in the end they are able to support her in case if there is any support required, and she should have a good infrastructure that also. Okay, it's an easy way to remember this. So this was what makes an organization sustainable. So there was one final topic that I wanted to cover, which is the meaning of strategic financial management. It is pretty simple, but I think I missed saying it when I was reading through the start. So what is strategic financial management? As you have already understood, the strategy plus finance plus management of that by the people makes up the word strategic financial management. Okay, so what does it combine? So here what happens is there are two aspects which are combined here. One is your accounting and then is your financial management. Okay, so here what happens is that whenever we talk about accounting is a backward looking, report focused discipline. It does not give you any insight how you can grow your business, how you can make it better. It is just a report focused discipline where you just get reports from it, and it is very backward looking. Nowadays people just does not want only reports. Okay, you also want that how you can manage your money with that reports, how it will help you grow your business, how you can manage the right finances by investing it at the right places, and what are the returns you're getting from it. So this accounting, when it gets involved or included with more dynamic, forward-looking subject of financial management, it makes up strategic financial management. So it is nothing but basically the identification of possible strategies which are capable of maximizing an organization's market value. Okay, so if you are able to find out strategies which are amazingly good, which can help your organization take your market value to the next level or help it maximize, then that is basically what is strategic financial management about. Okay, yes, with this we end our chapter. Okay, so I have completed the entire chapter now, and with this there are a few more paras which you can just go through and you'll be able to understand. Okay, yes, so after this video, here we have now secured 4 marks in exam, and I hope that everybody understood everything. In case if there is any question, you can leave that in the comment section below so that I'll answer that whenever I read them. And there will be a part 2 of this video coming soon. The part 2 will involve a quick revision video whereby I'll revise this entire chapter in just a span of 10 to 15 minutes, so that it will be helpful for you to revise 1.5 days before the exam. Okay, so yes guys, thank you so much for watching. In case if you like this video, please make sure to like, share and also subscribe to the channel, and don't forget to hit on the notification icon so you get updates regularly. Yes, thank you so much guys. See you in the next video.